Hello everyone. Today I'm going to take up one of the most hottest topics that is generally sometimes students found them, to be getting haunted with this topic, which is basic variances. It is step one when I say of the variances, because once you have basic variances, then you have advanced variances, and then we have planning and operational variances. So it is like a step one that we are covering. To whom it may be very relevant, it will be relevant to the students who are appearing for your MA exam, PM exams, and even APM exams. And even I find this topic to be very relevant for the students who are doing ACCA or CMA, CPA, all these students. See, basic variances is basically trying to understand that why an organization looks for this variance analysis. What is the relevance of it? How do you calculate it? Okay, and how do you interpret these results to be? Now, let's understand one thing. Every organization, it sets targets for itself. Or let's say before the start of the period, they determine that generally what will be the expected levels of the different cost, the different sales volume, sales prices for the different products should be there. Like for example, an entity will set a target looking at the market conditions that we should achieve a sales volume of 2 lakh units in the year. By the year end, when we see the actual positions, we see that the actual units sold are actually 2,10,000 units. Now, do you think it's a good thing that the entity has done? You will say definitely yes. Why? Because target was to sell 2 lakh units, but actually the entity has been able to sell 2,10,000 units. So that means the entity has been able to do something better off, which is going to bring more revenue, more cash, and more better position for the entity. Correct? So what is this? Is this a good variance? Variance means the difference between what was targeted and what is achieved. So is this a good variance or is this a bad variance? It's a good variance because from the entity, from the organization point of view, it's a very good variance. Why? The entity has been able to exceed its target. So we can call it as a favorable variance. And when the entity is not able to achieve its targets, in this example only, the target was to sell 2 lakh units, but the entity end up selling only 1,80,000 units. So that means they are not able to achieve the targets. When you have this gap, we call it as a bad variance. Technically, we call it as an adverse variance. So variance analysis is typically analyzing from the sales point of view, from the cost point of view, and then when we go further into this topic, we will prepare an operating statement also just to see what was the targeted levels and where are we standing actually. Okay, because every company, every entity will work with the target set. And when we set these targets for cost, we call it as standard cost. Okay, and one thing which is very, very important is standard cost is always set. Standard cost is always set per unit. We never put standard cost as, let's say, even if I talk about materials and the entity wants to set a target for materials, that is how much kgs of material should be consumed. Entity will never keep a target of 5 lakh kgs of material because that's a very weird figure. Entity will always set a target for if the organization is manufacturing, let's say, 10,000 units of the particular finished product, then the entity will set a target that every unit should be taking only 2 kgs of raw material. So to manufacture 10,000 units, 2 into 10,000 20,000 kgs only should go to manufacture 10,000 units. So the entity will always set a target in terms of requirement or the kgs required per unit. Got it? Because now everything will depend upon what is the actual production going to be. Actual production is, let's say, going to be 10,000. So then my material will move according to this 10,000. So then we can say that as per the target, we should have used, the entity should have used 20,000 kgs of material only. But actually the entity has used 25,000 kgs of material. Now for cost variances, should I also treat it in a favorable manner? That the entity expected that the organization would use 20,000 kgs of raw material to manufacture 10,000 units. But it actually ended up using 25,000 kgs of raw material to manufacture 10,000 units. Is it a favorable variance? From the cost point of view, no. Why? Because more kgs means more cash outflow. Okay? More expenditure. So definitely it is going to lower your profits. So from the profitability point of view, it is an unfavorable variance, or we call it as an adverse variance, because we are exceeding the targets and by consuming more raw materials than desired. Likewise, we can do the variance analysis for labor, and we will also continue to do further for variable production overheads, for fixed production overheads. Okay, and then we will look at an operating statement just to summarize everything. Okay, so I hope that the basic background for variance analysis is clear, and we have an understanding about that what, why and how. What, why and how do we do a variance analysis for? Okay. Let's proceed and let's start with a simple question so that we have absolute 100% clarity for the material and the labor variances. Then I'll go further and I'll take more examples for the same. Okay, so let's start doing this question. We have as per my example, standard cost for one unit. Now you know why? Because we have already discussed it. Material required is, as per the standard, the material which should be taken should be 5 kgs per unit. Okay, to make 1 unit. And the cost of the material is $10 per unit. For labor is, the labor required is 6 hours per unit. And the cost of the labor is $20 per hour. These are all expectations. Actual cost is, now given the detail of actual cost, 1500 units were produced using 5000 kgs of material and 3000 hours of labor. Calculate, now the question wants me to calculate material and labor variances. Okay, now let's go step by step into understanding these variances. Now the first variance that I will be taking up would be the material variance. Okay, one thing very important, see, we express the difference in dollars. So your final answer would always be in dollars. Okay, now let's take the first one. So I am taking material variances. First variance that I am taking under this category is MPV, that we can say that. It is material price variance. And the next one that I am going to take up is material MUV, material usage variance. Now, what is MPV? If I have to look down at the formula, material price variance. That means we have to see what is the variance. What is the variance due to a change in material price? That is from the expected material price per unit to material price actuals. What has been per unit, per kg. For materials, we will see per kg. So I will have here material price variance will be the difference between standard price per kg less so it will be standard price per kg less actual price per kg, and this whole multiplied with standard cost per this is price per kg difference we have taken, then multiplied by actual kgs. So we will get the total value for a material price variance. Now likewise, let's do for material usage variance. So material usage variance would be it will be the difference between, now usage means what? Usage means how many actual quantity of or how much kgs of material will be used to produce the actual units. Okay, so as per standard, ideally how much kgs should be used? Like in our example, I took 20,000 kgs. And actually how much kgs we have taken? Like in our example, we had 25,000 kgs, right? So the difference between the kgs and multiplied by with standard cost per kg. So here I will take the difference between standard kgs for actual units less actual kgs. This whole multiplied with standard cost per kg. Okay, simple. Let's work it out. So now in this question, let's try to solve how would I calculate material price variance and how would we calculate material usage variance. It is a base variance because on the same lines like we do a material price and material usage, we will be doing labor overhead variances and variable overhead, labor variances and variable overhead variances. So it's a base variance with which we calculate. Okay, now let's calculate here. Now, as per the question, what is the price per kg? Yeah, as per the question, what is the standard price? It says price per unit is 10. Okay, and here actually the price per kg is, we will find it out. Oh, I'm not given that data. Just a minute. I will mention it. 1500 units were produced using 5000 kgs and cost is $3 per kg. Okay, and here just see, when the cost is given to me, the price is given to me per kg. Okay, the price is given to me 10 per unit. There are 5 kgs that a unit takes. So what is the price per kg? 10 divided by 5. So here I can derive it and I can write here price per kg is $2. Got it? How? 10 divided by 5. So sometimes the questions will give you data like this and then it is we have to use the data and calculate the variances. Okay, so let's go further and let's discuss it here. So this is 2 per kg. Now I'll apply the formula here. Standard price is $2 per kg. But actually how much we are paying? We are paying actually to the vendor at supplier at $3 per kg. So we are paying more. It's an adverse variance, right? It's an adverse variance and multiplied with the actual kgs. Actual kgs are 5,000. So the calculation will be now. So here you will have adverse 1 variance because you are paying more. You are paying more means the entity has to shell out more. That means it is an adverse variance. So we will have adverse variance calculated and that will be $1 multiplied by 5,000. So it will be negative 5,000. Negative 5,000 means what? That means it is an adverse variance because you are paying more. Got it? So we will not present it as a negative sign. We will write it here $5,000 adverse variance. If you want to show it, we can show it like this also. That means it is an adverse variance. Now what do you see here in cost variances? I actually see if my actual is more, we have adverse variance. But when we go to a sales variance, you will find that when your actual is more, it's a favorable variance. The reason being, it means you have sold more. You have sold at a higher price than expected. So it is better for the organization because more inflow will be there. Clear? Now let's go further and let's discuss the material usage variance also. Now as per the material usage variance, as per the standards, ideally to manufacture 1500 units, what should be the standard? As per the standard, the kgs that should have been taken. Let's check it. So as per the standard, a per unit material would be 5 kg consumed as per the standard. So if the total 1500 units, the actual as per the standard, material consumed should be 1500 into 5, which is 7500. So let's calculate this as well. So that will be 1500 into 5. But what is the actual kgs? Let's see. Actual kgs are only 5,000. What does it shows? It shows that the entity has been able to save material. Save material means saving cost, which is favorable for the organization. So you can see here, the entity has been able to save cost. Why? Because these are the number of kgs as per the standard that should have been there. And this is the actual kgs which the entity has actually taken. So how do we calculate this standard kgs? Again, when I repeat, it is 1500 units multiplied by 5 per kg. So I get the total number of kgs that will be required to manufacture 1500 units. And actual kgs are 5,000. Okay, so this is the difference. This multiplied by, now I need cost. So I will take standard cost per kg. Standard cost per kg is, we have just calculated here 2. So I will take standard cost per kg as 2. So what do I get? 15 into 5 is 7500. 7500 kgs less 5000 kgs multiplied by 2. So I get 2500 kgs multiplied by 2. This much is the saving. So it's a positive variance. 5000 again here I am getting. But now here it is a favorable variance. Now I hope it is absolutely clear. So now we have a good hold of material price variance and material usage variance. Material price variance is again simply the difference between what is the standard price per kg that is expected less what is the actual price per kg that is actually the price that we are paying to the supplier. The difference is then multiplied with actual kgs to get the overall variance due to prices. Then material usage variance is about that what is this as per the standard, how much kgs actually should go in for the production of these actual units of 1500, and as per actuals, how much kgs has the entity taken. So if the entity has taken less kgs, it's a favorable variance. You know why? Because now as per the expectations or as per the standard set, the entity has performed better. So we will have a favorable usage variance here. Okay, and this then we multiply with the cost per kg, which is standard. Going to the next one, let's handle the labor variances as well. So now let's draw down the labor variance formula chart. So I will take here labor variances. Labor variances are again in two types. First we call it as labor rate variance, and the next one is labor efficiency variance. Okay, now what is labor rate and labor efficiency variance? So I hope we remember the material variances, right? So they are exactly on the same line, right? Now let's continue here. So what is labor rate variance? Let's draw down the formula. Again, labor rate variance. So that means we have to see what is the variance that is taken place due to the changes in what was the expectation of for the labor cost that the entity will be bearing to pay the labor per hour. And actually, how much are we paying the labor per hour? If you're paying more, adverse variance. If you're paying less, favorable variance. And then multiply it with the actual hours. Okay, now let's see. So here we have labor rate variance. So the difference is what is the standard, what is as per the standard labor rate per hour, and I will reduce from it actual labor rate. Rate means it's a dollar, okay, per hour, and the difference then you will multiply with actual hours, because then we will see with respect to actual hours for the labor for which we have hired him, that how much is the variance in totality. Likewise, for labor efficiency variance, we check the efficiency of the labor. How quickly are they able to perform the task? So as per the standard, let's say the standard was that the labor should take 2 hours. I'm just taking an example, random example, that the labor should take 2 hours to manufacture 1500 units. But the labor actually took 4 hours to manufacture the actual units. That means what? That the labor is efficient? No. You will say, no ma'am, labor is not efficient. The reason being the labor has taken almost double time than expected to complete the task. So here it shows inefficiency of the labor. So that will be an adverse variance. Let's draw down the formula and do this question. So here I will take labor efficiency variance and I will take the difference between what is the standard labor hours required to manufacture actual units less what is the actual hours taken. And then we multiply it with standard labor rate per hour, because then I'll get the value in totality. Clear? Now let's solve this question with respect to the example that I've given you here. So it says that as per the standard for 1 unit, labor required is 6 hours and the cost per hour is 20. Here I had intentionally given per unit and per hour, so that if you have to find out per kg, and per unit, it is not difficult for you. Now, 6 hours per unit and the 20 per hour is the labor rate as per the standard. As per actuals, the organization has taken 3000 of labor hours actually. and the labor cost is $15 per hour. So this is the actual labor cost. Now let's solve this question. So now here I will take what is the standard labor rate per hour. 20 we have just seen here, and 15 is the actuals. So as per the standard, the labor should be paid 20 per hour. But how much are we paying the labor actually? We are only paying the labor 15 per hour. So are we saving organizations money? Yes, we are saving organizations money. So is it a favorable variance? Yes. Now this is the labor rate per hour. So I need to multiply it with the number of hours, and we always take actual hours. Actual hours are 3000. So I will multiply it with 3000 hours. Now I will get 20 minus 15 is 5 per hour. And I will multiply it with 3000 hours. So I get here 15,000 is my favorable variance. Why favorable? Because we have been able to save organizations money by hiring the labor at lower rate than expected. Got it? Now let's go to the next one. So now we have the efficiency variance. Was efficiency, we just discussed that how effectively and quickly the labor is able to do the task. Now let's see, in the question it is given that as per the standards, for every unit 6 hours of labor are required. Now actual units are 1500. So as per the standard, how many labor hours should be required to make 1500 units? 6 multiplied by 1500. This will be the standard hours, right? From this I will reduce what is the actual hours. Actual hours are 3000, we have just seen. Now you will take the difference. Now this difference you multiply with standard labor cost per hour, which is 20. So now let's see whether it's an adverse or a favorable variance. Now look here, people. As per the standard, the labor time required to make 1500 units is 6 into 1500, which is 9000. But actually, it's too drastic. We have only taken, let me just change it a bit. Okay, I will take it at 8000 hours. It just looked too different. So let me make it 8000 hours. See, it will be 40,000 variance. Now when I have here 8,000 hours. So now as per the standard, the entity should have taken 9,000 hours to manufacture 1500 units. But actually, the entity has taken only 8,000 hours. Here also we have a favorable variance because actually the labor has taken less time to manufacture 1500 units. They have been effective, they have been efficient, they have been quicker, right? So now here we'll have a favorable variance. So my variance will be 9,000 hours less 8,000 hours multiplied with $20 per hour, which is standard rate. So it will be 1000 into 20. So that will be 20,000 is the favorable variance. Clear? Absolutely. So now we are done with material variance. We are done with labor variance. Now I'll continue the example and we will take into account the variable overhead variances as well. So let's understand the third one and I will continue the example. The third one is variable overhead variances. So just like we had the material, we had the labor, now we have variable overhead variance. And one basic thing which I'm sure everybody is very aware of is variable overheads also move like labor. So variable overheads are very much dependent on the labor variances. The way that the labor, because they're dependent on the labor hours. So the way that the labor variances move on the same line, the variable overheads also move. Okay, now here again we have two categories. The first category is variable overhead expenditure variance, and the next one is variable overhead efficiency variance. Again the same logics. What are the variable overheads? Variable overheads are those overheads which are like not directly related to the manufacturing of a product, but they are ancillary. Like it can be the hours that is needed to manufacture the goods. Like for example, the electricity hours. Like so, they are the variable overhead, because the more the hours, the more will be this cost. So, and since it is a common cost for all the products which are being manufactured, so I don't call it as a direct cost, I will call it as an indirect cost. Okay, so I will treat it like an overhead cost. And since it is moving with the number of labor hours, so we will call it as a variable overhead cost. Okay, because it is vary with the number of units, with the number of hours. So now let's draw down first what is the expenditure variance. What is variable overhead expenditure variance? Okay, so what is the variable overhead expenditure variance? It is just like your labor rate variance, nothing different. Okay, so now again here you will take the same formula. So here we will take variable overhead expenditure variance. What is the standard variable overhead cost per hour? Because variable overhead also moves with labor hours, correct? Now from this I will deduce what is the actual variable overhead cost per hour. Now this you will reduce and you will multiply it with actual hours. And which hours? Labor hours. Done. Just like labor overhead, just like the labor variances, we have calculated here variable overhead variances. Now let's talk about the next one, variable overhead efficiency variance. So that will be again, just like we tested the labor efficiency in the previous one, here also we are testing the variable overheads efficiency. That how quickly with these overheads are we able to convert, how quickly these hours are basically working more efficiently for the actual unit. So just like labor hours, what is the efficiency level is that what we are checking here. Okay, it can be even the man hours taken to do the secondary packing of the product. That is also secondary labor cost, right? So for that, all that is also covered under the variable overheads. So the same rule will apply as this applied to labor cost will apply to variable overhead cost. Okay, now what is the variable overhead efficiency variance? So I will take the difference between, as per the standards, what is the standard hours and which hours? Labor hours. So you will never forget it. What is the standard labor hours per unit? And from this I will reduce what is the actual hours. Okay, here we had to just add one more, just a minute. Okay, what is the standard labor hours per unit multiplied by actual units? Then only we will get the total standard hours. From this I will reduce actual hours. And this whole we will multiply with standard variable overhead cost per unit. Okay, standard variable overhead cost per hour, because everything is in hour, so I will take per hour. Got it? Just like labor variances, we are going to be dealing here. Now I will take a small example for the same in continuation of above. So I will write here. Okay, continuation of above example. Okay, standard variable overhead cost per hour is, let's say, $10, and actual variable overhead cost is $12 per hour. Actual hours and every data is already there, so we will use the same data. Okay, now let's proceed and let's solve this question. So now when I solve it for this variable overhead expenditure variance, I can write it down as, so my variable overhead expenditure variance in our example would be in brackets. Now what you will take? You will take the difference between what is the variable overhead as per the standard labor cost and as per the standard, and what is the variable overhead as per actuals per hour. Okay, so here I have given that the standard variable overhead cost per hour is 10 and variable overhead cost actuals is 12 per hour. So let's take the difference. $10 per hour less $12 per hour. Okay, multiplied with the actual number of hours, which was 8,000 hours. We changed it, right? Because we will always take labor hours. Now just see here, guys, as per the standard, as per the expectation that the entity had, the variable overhead should be $10 per hour only. But actual expenses have been more, and due to which the actual variable overhead cost is now risen to $12 per hour. Is this good for the entity? No, because it would mean more expenditure. So it is not good for the entity, and therefore it is going to be more expensive. More expensive means adverse variance or unfavorable variance, right? So what is the adverse variance here? $10 plus $2 is $2 in negative per hour multiplied by 8,000 hours. So that will be equal to 2 into 8 is 16,000. 16,000 adverse variance. Clear? We are done with the variable overhead expenditure variance. Now let's discuss the variable overhead efficiency variance. Okay, let's discuss the variable overhead efficiency variance. So you know the formula. Variable overhead efficiency variance would be, now we are testing the efficiency, right? So it is all about hours. We are testing the efficiency. It is all about hours. Now that will be equal to what? So that will be equal to what is the standard labor hours to manufacture the actual units less what is the actual hours taken. So you will say, ma'am, it is almost similar to what we did in labor, exactly same. Just that when you are multiplying the standard cost, instead of taking the standard labor cost per hour, you will take standard variable overhead cost per hour. That's the only difference. Okay. So now here I will take variable overhead efficiency variance. So as per the standard, I can take the data that we used in the last question. So 9,000 hours was the expectation as per standard, and actually we have taken less hours as 8,000. So I can take here 9,000 labor hours less 8,000 labor hours. And what is the standard variable overhead cost per hour? That I've already given you here 10. So I will take here multiplied by $10 per hour. So how much do I get? It's a favorable variance because we have been able to take less time than desired. So that means it is a favorable variance and the entity is going to be, receiving the benefits from it. So it will be 1,000 hours multiplied by 10 per hour. So it will be a favorable variance of 1,000 into 10, 10,000. 10,000 10,000 favorable variance. Okay, just to tell you all, guys, if you all have not yet liked and subscribed and press the bell icon for the different notification that you will be receiving for the multiple videos, which will be always uploaded in these, topics especially, and also the live streamings on that will be there. So if you have not done that, please do it right now. Okay, please do it right now. And also for any questions and queries, you can put it in the chat box and I will revert back to you. Additionally, do let me know whether you're able to have the understandings properly or not. Okay, and put your comments in the chat box. Okay, let's go further. So what we have covered so far, we have covered 3 variances: material variance, labor variance, variable overhead variance. These are the 3 cost variances that we have covered. Now I will take you to first a sales variance, and then we come back to fixed overhead variance, which is also again one of the other cost variances. So let's go and let's move further and let's be clear about the 4th variance that I'm discussing, that is relating to the sales variances. Okay, so the 4th variance that I'm discussing is relating to the sales variance. Let's take them here. So I'll take the 4th one. The 4th one is sales variances. Now, here things will move opposite, because in cost we try to save cost. In sales variance we try to increase the selling price. We try to increase the volume. So here we will go opposite, right? In cost we try to bring down the cost, and in sales we try to increase the sales. So always move in opposite directions. Okay, now here how many variances we have? Again 2. So two categories. First one is sales price variance. And the second one is sales usage variance. Okay, sales price variance and sales usage variance. Now everybody, how to calculate a sales price variance and how to calculate sales usage variance. So sales usage variance is again further divided into 2 categories. So here we will have number 1, I will have, okay, that is we will calculate sales usage variance in the marginal costing environment. What difference will it make? I will tell you that time. And the second one, we will do it in absorption costing environment. In case if you are having trouble in understanding or recollecting, marginal costing and absorption costing, that you can watch the video on basic concepts of costing that I've already uploaded earlier on my channel. Okay, so watch that video and have a basic the understanding of these basic concepts. What is absorption costing? What is marginal costing? Now, absorption costing environment. First, I will take sales price variance. So now, as it suggests, what is sales price variance? Sales price variance is the difference between what is the standard selling price that was expected at which the product should have been sold, less what is the actual selling price. Now just look here, if your actual selling price is more, is it good for the entity? Yes, because that would mean that the entity will be able to generate more revenue, more inflow, so it's definitely a favorable variance. Okay, so now here you will take the difference between standard selling price less, I'm using short forms, actual selling price. Okay, and this multiplied with, now what you will multiply? So for that you need to know one more thing, that when I take standard selling price, I will take per unit. Because of course, now you're selling the goods, so you're selling the goods in units, right? Actual selling price per unit. You reduce it and you multiply it with actual quantity. Actual quantity is in units. Okay. Now I come to this point, which is sales usage variance. Now what is sales usage variance about? Sales usage variance simply is about that, usage, or actually no usage, sorry, it is sales quantity variance. Because usage doesn't make sense here, it's sales quantity variance. Just went with the flow. Okay, sales quantity variance means simply it talks about volume, that what was the as per the standard, what was the targeted units that should have been sold, and actually how many units we have been able to sell. If you are able to sell, or the entity is able to sell more units than expected, is it a favorable variance? If the entity has been able to sell low units, less units than expected, is it a favorable variance? No, it is an adverse variance. The reason being, the target was to sell 2 lakh units, but the entity has only ended up selling 1,80,000 units. So the entity has a shortfall of 20,000 from the target. Hence, it is an adverse variance. Now you will say, ma'am, that is understandable. But tell us why you have written here marginal cost and absorption costing environment. Because when I say that the units sold have been more or less, what do you multiply it? You will say, ma'am, standard selling price per unit. No, that's the difference. When it comes to sales quantity variance, then our focus is on ultimate profitability. Okay, because ultimately now we need to know that what is the profit position of an entity, whether the entity by selling more units has been able to increase the profits or not. Okay, so now why I use here marginal costing and absorption costing, I know some of you may have been able to understand that marginal costing focuses on what? Maximizing the profits? No, it focuses on maximizing the contribution per unit. So when the question says that the entity follows marginal costing methods, so then when we take the difference in volume, I will multiply it with, not with the standard profit per unit, rather I will multiply it with standard contribution per unit. Why? Because marginal costing environment focuses on maximizing the contribution and not maximizing the profits. Clear? And when we are in the absorption costing environment, then the focus is on maximizing the standard profit per unit. Though it is not asked, but if let's say the question gives you a throughput environment, then you know your focus will be on maximizing the throughput. But typically for the sales quantity variance, we always do it either under marginal costing environment or absorption costing environment only. Clear? Now, when the entity is having marginal costing environment, then guys, what is the formula that we will be using? What are you going to take the difference between standard quantity to be sold as per the expectations less actual quantity that we have been able to sell multiplied with standard contribution per unit. And when I say I have to look for standard profits, standard profit per unit. So here I will take the difference between standard quantity less actual quantity and multiplied with standard profit per unit, because it is absorption costing where we focus on maximizing the overall profits. Clear? So now again I will continue with the above question and let's add more data. So here I will continue. So I will write here continuing with the above example, the following data is provided. Okay, which is actual sales is 1500 units, that was already given to us. Okay, and that production and sales we are assuming to be same, and actual selling price per unit is $25 per unit. Then standard, or I will say budgeted units to be sold are are 1000 units. Okay, and one more data, the profits and all. So I will say here that the entity is following absorption costing method and is expecting profit of $5 per unit. Actual profit is $6 per unit. So this is the information which is given to you, okay, about the actuals and the standard. Now let's apply it and let's calculate the different sales variances. So now let me first calculate what is the sales price variance. So as we have already discussed, it is a difference between what is a selling price per unit, standard and actuals. As per the standard, the selling price per unit is that I will give you. Budgeted standard selling price is $30 per unit. Okay, $30 per unit. So now here, when I take the calculations, now what is the standard selling price per unit? $30 that we have just calculated. We have just given the figure. So $30 per unit less. What is the actual selling price per unit? Actual selling price per unit is $25. And multiplied with actual units. Actual units sold are 1500. Is it a favorable variance? Actually, we have been able to sell the goods at lower price than expected. Maybe we ended up giving more discounts just to increase the demand of the product. So is it a favorable variance? No, it is adverse. And we are working below expectations. So it is an adverse variance. Hence, I will do the calculations here. And 30 minus 25 is $5, and that will be an adverse variance. This I will multiply with 1500 units. So my adverse variance will be $7,500 adverse variance. Clear? Now let's go to the next one. Next one is sales quantity variance. Sales quantity variance, or even we call it as sales volume variance. So I think let me change the name to volume only, because when we do advanced variances, that time it may be just confusing to you. So I'll not confuse you here. Let's put it as sales volume variance only. Okay, volume only, and everywhere I will write sales volume variance only. So that when we do the advanced variances, they really don't trouble you. Okay, sales volume variance. Okay, now look here. So we have sales volume variance. Now you know that as per the question, the entity is in absorption costing environment. As per the question, correct? So let's follow the standard, the absorption costing rules, which is you will take the difference between standard quantity sold to be sold less actual quantity actually sold, and the difference multiplied with standard profit per unit. Now you know why? Because in an absorption costing environment, the focus is on maximizing the profits. Clear? So let's do it here. So now what is the standard quantity sold? Standard quantity sold is 1000 units. As per the standards, quantity to be sold was 1000 units. Less, what is the actual units sold? 1500 units. Multiplied by standard profit per unit is 5. Now you can see I have taken actual profit also. It's not to be used anywhere apart from you making it used in the operating statements. So which is more relevant for MA when we prepare the operating statements. Okay. Now here, so 1000 less 1500 is 500 units. Now we have been able to sell more. Actually, the units sold are more. So it's a favorable variance. Multiplied by $5, the standard profit per unit. So it will be 500 units adverse variance. No, favorable variance. Reason being, we have been able to sell more. The organization has been able to sell more. Multiplied by $5 per unit. So it will be equal to 5 into 5 is $2,500 favorable variance. Right? I hope everybody is absolutely clear till this point. So far we have covered material variances, labor variances, variable overhead variances, and sales variances. Now I'll give you a break of 10 minutes. Post which we will do fixed overhead variances and operating statements. That is reconciliation between the standard profits and actual profits. So let's take a 10 minutes break and then continue further. Yes, so let's continue here now. Guys, just a recap of what we have covered so far. We have covered sales variances, we have covered material variance, we have covered labor variance, and we have also covered the labor variances and the variable overhead variances. Let's cover the next one, which is, now I'll go to the fifth one, right? Yeah, so let's take the fifth one, which is fixed overhead variances. Okay, so now we are going to look at the fixed overhead variances. And I've always found students, the moment I say fixed overhead variances and they're like, ma'am, it's a very tricky variance. It is not, my friends. Always understand that you will never ever fumble if you don't try to rote learn it. Don't try to mug up. Understand everything logically, like we have understood in the above variances. Likewise, we'll understand here also. Then how do we calculate a fixed overhead variance? Now look at my screen. Again, here we divide it into two main categories. So number one is fixed overhead expenditure variance, and the number two is fixed overhead volume variance. What is fixed overhead expenditure variance concerning about? So it is basically simply about that we take the difference between, in a very simple terms, it is only focusing on expenditure. That is, what was your budgeted expenditure overall going to be? Since you know fixed overhead, it doesn't move with the number of units, right? So we focus here on the total expenditure. So we will look here, what is the total budgeted fixed overheads as per the expectation? What was the total budgeted fixed overhead? That will be in dollar. And how would you calculate it? What is the standard capacity? Because fixed overhead it's not incurred for like 100 units and 200 units and so on. If the capacity level of the factory or the organization to manufacture the units, it's let's say 1000 units. So then we will take it for 1000 units only. Okay, so we will see that what is generally the expected, nothing given, then we take what is the expected output for an organization. Okay, so we'll take the expected output here. So standard capacity or output. Okay, in units, and multiplied with what is the standard fixed cost per unit, because that is generally given, no, as we get the standard cost sheet per unit, so that will include the standard fixed cost per unit as well. Now, so that is basically your budgeted fixed overhead, which is standard capacity or output in units multiplied by standard fixed cost per unit. From this, you will reduce your actual fixed overheads, actual cost. Simple. So you are just taking the difference between expenditures, that's all. Okay, this difference that you take is your final answer. Clear? So we are basically taking the difference between budgeted fixed overheads and the actual fixed overheads. And the answer will be in dollar, that will be a final answer. Now let's take the next one, which is your volume variance. Now volume variance is focusing on volume now, units. Okay, so now here we focus on what is the actual capacity of the organization, the production capacity, or what is the actual production that the entity is doing, and what was the expected production. So if we are doing more production, it's a favorable variance, because more production would mean that the fixed cost will be allocated more efficiently. And if you're doing less production, then it's an adverse variance, because then fixed cost will not be able to be spread out, efficiently over the different products. So here we take the difference between budgeted volume in units less actual volume, and that we multiply with standard fixed cost per unit. Got it? Now this is how we get our volume variance. Now people's story doesn't stop here, because volume variance is again divided into two categories. So I will write here. Fixed overhead volume variance. It is divided into two categories. Okay, that is like a subcategory. First one is fixed overhead volume capacity variance, and second one is fixed overhead volume efficiency variance. Okay, these are the two subcategories that we have. Now, how do you calculate fixed overhead volume capacity variance? So now here we are focusing more, like we discussed, it's focusing more on capacity, but in hours, not in units, but in hours. So let's see, how do you calculate the fixed overhead volume capacity variance? So look here, it is simply the difference between what is the budgeted hours. Okay, and I hope you remember how we calculate the budgeted hours. That is simply multiplication of the budgeted hours per unit multiplied by the budgeted units. Simple. Okay, because we are looking at capacity. So the focus is that the organization should work its fullest to the capacity. Okay, now from this I will reduce actual hours. And then I will multiply with standard fixed cost per hour. Clear? Standard fixed cost per hour. So we are done with this. Now let's calculate the next one. The next one will be fixed overhead volume efficiency variance. Labor efficiency, variable overhead efficiency, fixed overhead efficiency. All three in the same lines. So here also we are focusing on how is the labor efficiently doing the work or not. So here again I will take here what is the standard hours to make actual units. The same way that we did labor, the same way that we did variable overhead, same. Okay, less actual hours. And this whole multiplied by standard fixed cost per. Clear? So then we will multiply this with then standard fixed cost per. Got it? So now let's repeat this again. So first we are going to have fixed overhead expenditure variance, fixed overhead volume variance. Expenditure is only focusing between what is the budgeted expenditure, what is the actual expenditure. If your budgeted expenditure is more, then it's in, and your actual expenditure is less, favorable variance. Why? Because you are having less expenditure. When we look into volume variance, now the focus in volume is always to achieve those capacity levels. So we will see what is the, the output budgeted and the actuals. And if your budgeted output is less, actual is more, favorable. Otherwise, opposite. Okay. And then we divide this volume variance into two subcategories, efficiency and capacity. Efficiency is duplicate labor, duplicate variable overhead. Take the difference in labor hours and multiply it with the standard fixed cost per hour. Likewise, for fixed overhead volume capacity variance, you will focus on capacity in hours. That what is the total hours available as per budget, and are we able to reach that level or not? If you are not able to reach, it's an adverse variance. Clear? Now what I suggest is, let's take up a question and then solve it. So then we will be able to solve a full-fledged question along with the fixed overheads portions as well. Okay, so I'll take up a question and we will start solving it so that we have 100% crystal clarity. Okay, so let's solve it. Guys, these are the capsule notes. That I provide along with the sessions and along with these topics. In case if you want it, drop your email ID in the comment section, in the chat section, and I will make sure these reach out to you. Okay? Now, everybody, let's focus on this question. It's a good full-fledged exam-oriented question. So everything will be 100% clear after we do this question. Now, a company produces and sells one product only, the thing. Okay, it is the thing. The standard cost for one unit being as follows, which is 200 for direct material A, 30 for direct material B, and 30 for direct wages. So it's given in dollars. And apart from this, we have also been given the number of kgs required per unit. You can say it is for per unit because I've already told you standard cost is per unit. Number of kgs required per unit. The rate per kg is also given to you. Direct material B is in liters. So the number of liters and the rate per liter is given to you. Likewise for wages, the number of hours to make 1 unit and the rate per unit is also given to you. Fixed production overhead in totality is given to you per unit, which is 50. The fixed overhead included in the standard cost is based on an expected monthly output of 900 units, my capacity level. Fixed overhead absorbed is on the basis of direct labor hours. So when we do the efficiency in the capacity variance, I would be depending on direct labor hours. During the April month, the actual results are production is 800 units, material A actual, material B actual, and wages and the fixed production overhead. Everything is given to you here, actuals. Now let's calculate the questions one by one. It says, please calculate for each of the materials, material price variance and usage variance. So let's do the calculation here, guys. We will do it on the other sheet. Okay, we will do it on the other sheet so that we have clarity here. Now, so I will take the solution here. First, I will take material price variance. This is for material A and this is for material B. Okay. So let's draw the format. So first I would be needing what is given to me. If you look here, while I was reading the question, actual results gives me the total actual material cost, right? So I don't need to make it per kg and then do the calculations for the same again. Instead, for standard we can do. So when I'm calculating the material price variance, I can take the standard price per kg and multiply it with the number of actual kgs. So I will get the standard cost, I will have the actual cost, get the variance, and you will get the answer. Okay, so let's see for material A. For material A, the standard cost per kg is 20 because we are looking at price variance. So that means I would be depending on the price per kg. Price per kg standard is 20 and number of actual kgs produced are 7,800. So guys, can we calculate and type down 7,800 into 20? So here I will write the standard price per kg multiplied by actual kgs. Okay, this is number one and this will be actual material cost. Okay, now what is the standard price per standard price per kg? 20 that we had seen here, $20 multiplied by actual kgs were 7,800. So that would be equal to 20 into 7800, right? 7800 into 20. Now when I multiply it, I get 1,56,000. Likewise, I can do for material B as well. So what is the standard price per liter? Per liter for material B is $6. Okay, and what is the quantity manufactured is 4,300. So $6 into 4,300 we will do. So it will be equal to $6 per liter multiplied by 4,600 liters. Right, so $6 into 4,600. Yeah, $6 into 4,300. So what will it be? Let's multiply it. And I get 25,600. 25,800. Okay. Now actual material cost is already given to you. Actual material cost of material A is 159,900 and for material B is 23,650. 159,900 and 23,650. So 159,900 and 23,650. Now people, just focus here. As per the expectation, your cost should have been 1,56,000, but the actual cost is 159,900. You spended more. You have shelled out more money of the organization, more expenses. So reduction in the profits. Is it a favorable variance? No. So I will write here, it will be 3,900 adverse variance. We will denote it as A. Okay, now let's check the next one. As per the standard, the material cost should have been 25,800. But actually, we have been able to save money and it is at 23,650. So now you can see here, we have been able to save money. Save money means what? Is it a favorable or adverse variance? Favorable. How much favorable? When you reduce it's 150 to 2150. Favorable variance. Okay, so we will write here 2150 favorable. F denotes favorable, A denotes adverse. Clear? Let's go to the next one. Material usage variance. Now when we take material usage variance, you know the formulas. So let's do for both the materials. Material A and material B. Usage variance simply sees how much of the standard kgs are required to make 1 unit multiplied by actual units. So we will know that how much material should be used to produce these actual units as per standards and what is actually used. Okay, so let's do it here. The first step is standard kg per unit multiplied by actual units. Okay, so let's apply the formula here. Standard kgs per unit for material A is 10 kgs. That ideally 10 kg should be used to manufacture material A for 1 unit. So if we have actual units of 800, that is the actual production is 800 units, then what is the total material required? 800 into 10, 8,000 kgs. Correct? And what is the actual kgs? 7,800. So it is 800 multiplied by 10, which will be 8,000 kgs. Now I will write here actual kgs. Actual kgs are 7,800. So boss, we are able to save because we are doing the same production in less quantity of material. Very good. So 200 kgs is your favorable variance. And now we will multiply it with standard cost per kg. Standard cost per kg we had seen above was 20. So ultimately we have material usage variance 4000 favorable for material A. Let's see for material B. Now material B, as per the standard, 1 unit requires 5 liters, should be made with 5 liters of material B. And 800 units are there, so 5 into 800 is 4000 liters. Actually we have taken 4300 liters more. So it will be and actually we have taken 4300 liters. So it is more means adverse because actually we have taken more. So if you take more people, that means more money is going out of the organization, more expenses. So it's a adverse variance. So here I will write 300 liters is adverse variance. Now you multiply it with the standard cost per liter, which is given here 6. So I will multiply it with $6 per liter. And then I get here an adverse variance of 1800. So 1800 is adverse variance. Clear? We are done with material. Now let's go ahead and let's discuss the variable over the labor variances. So let's go to the next one. We just have one labor variance. And there is no variable overhead variance here. It's only labor and then fixed overheads. Okay. So now let's do the labor variances. I'll do the third one. Labor rate variance. And then we will do labor efficiency variances. Okay. Now here labor rate variance will be, you will take what is the standard rate. Now here also do we have the total labor cost? Yes, we have total labor cost. Let's get the total amount then. What is the total cost? So like here we did the same way. That is what is the labor rate? Standard labor rate per hour multiplied by actual number of hours. Okay, so it will be equal to, and then we will compare it with actual labor cost, and finally you will have a variance that we will be considering. So let's calculate here. What is the standard labor rate per hour? Standard labor rate per hour, guys, if we see here, the standard labor rate per hour is $6. This is the standard labor rate per hour, correct? And what is the number of actual hours? Actual hours are 4200. So as per the standard, the total labor cost for actual hours should be 4200 into 6. And the actual labor cost is 24,150. Let's apply it here. So it will be 4200 hours multiplied by $6 per hour. That will be equal to, I will calculate, and here it is 28,150. I will just cross check. 24,150. Okay, now the 4200 multiplied by 6 when we do, we get 25,200. So as per the standard, look here, as per the standard, the labor cost should have been 25,200. But actually what is the labor cost that we have incurred is 24,150. So are we spending more or less? Actually spending less. So is it a favorable variance? Certainly. Because for cost, wherever there is a cost saving, it's a favorable variance. So what is the favorable variance? Let's reduce it. 51. That's all. 11050. So 1050 is my favorable variance. Clear? Because we have been able to save money. Now let's go to the next one, the fourth one, which is the labor efficiency variance. Okay, now here let's do labor efficiency variance. So that we will calculate as what? We are looking at the hours, right? What is the hours to be taken to produce the actual units? So here I will take standard hours to make actual units. And we will compare it with actual hours. And finally, the difference that we have, we will multiply it with standard labor rate per hour. Okay, now let's see what is the standard. As per the standard, what is the standard hours to make actual units? So I think let's look at this. As per the standard labor hours to make actual units are 5 hours, right? Every unit will take should take 5 hours to be made. And there are how many units to be made? 800. So ideally the total hours should have been 5 into 800, 4000 hours. Actual hours are 4200. So we are taking more hours, right? So now you know it's an adverse or an efficient, or it is a favorable variance. So your actual should be 800 multiplied by 5, which is 4000 hours expected. Actual hours taken are 4200. So here we have 200 adverse variance multiplied by standard labor rate per hour that we have taken here 6. So the overall variance is 1200 adverse variance. Clear? Done. We're done with the labor variance. We're done with the material variance. I cannot see any variable overheads here. We are done with labor, material, but I can only see fixed overhead variance. So let's complete the fixed overhead variances. First, I will take the fixed overhead expenditure variance, then volume capacity, and then volume efficiency. So that will be like a full-fledged thing to complete here. So let's do a fixed overhead. Now let's do the fifth one. The fifth variance that I'm taking is fixed overhead. Fixed overhead expenditure variance. Okay, people, focus here. So it is a difference between your budgeted expenditure and your actual expenditure. So you will take what is the budgeted cost and you will reduce the actual cost. So budgeted cost will be budgeted units multiplied by fixed cost per unit. Budgeted units are 900, fixed cost per unit is 50. Actual fixed cost is given to you 47,000, so no efforts are needed here. So it will be 50 multiplied by 900 units. That will be 45,000. And actual is 47,000. Boss, you are incurring more actually. So it's an adverse or a favorable variance? Adverse. Very good. So $2,000 adverse variance because our actual expenditure is more. Let's go to the next one. Now we will do fixed overhead, volume variance. So people, let's do the fixed overhead volume variance. Volume means now you're looking at the units. So as far as I know, the budgeted levels and the actual units we will take. Budgeted units are 900 units and actual units are 800 units. So here we have a favorable or adverse. Adverse because the entity is not working up to its fullest capacity that ideally it should be working at. As the standard says that the entity should have a production of 900 units. But the entity is only able to produce 800 units. So overall volume wise the entity is going down, hence it is an adverse variance. Now you will multiply it with the normal formula that we do, standard fixed cost per unit. Yes, a question may be coming into your mind, ma'am, every time that we multiply it with the cost is always standard cost, always. So there are two thumb rules, please remember, for variance analysis, whether we do a basic variance or advanced variance. Wherever we multiply it with the cost per unit, we always take standard cost, or a profit, standard profit, or contribution, standard contribution per unit. Wherever we multiply it with the number of units, or number of hours, or number of kgs, we always take actuals. Actual units, actual hours, actual kgs. Keep this simple rule in your mind and you'll never be, confused between what to take. Now, so standard fixed cost per unit, which is here $20. No, $50. So when you multiply it, now we get our variance 5,000 adverse. Got it? So your volume variance is adverse 5,000. That means the total of your fixed overhead volume efficiency variance and the fixed overhead volume capacity variance will also be 5,000 only, because volume variance has two subparts, fixed overhead capacity and fixed overhead volume capacity variance and fixed overhead volume efficiency variance. Let's look at the two subparts here. So I will write it as 6A. 6A will be fixed overhead volume capacity variance. Fixed overhead volume capacity variance would be, now again you're looking at capacity but in hours. So when you have capacity and efficiency, they work in hours. But the concept is same. That means here you will take what is the budgeted hours, compare it with actual hours, get the variance and multiply it with standard fixed cost per hour. Okay, now you'll say, ma'am, we have been given standard fixed cost per unit, but you know the direct labor hours, right? Hours per unit. You divide it and get the fixed cost per hour. Let's calculate it. So what is the budgeted hours? Let's see. The budgeted units are 900, and as per the labor will take 5 hours per unit. And we know that here it is given that fixed overhead is absorbed on the basis of direct labor hours. So as per the budgeted units, what is the maximum hours available? 900 into 5, 4,500 hours. What is the actual hours used? Look at the labor, 4,200 only. So have we used till it capacity? No. That means we have idle time for our labor, which is not good. So now here we will have 900 multiplied by 900 units multiplied by 5 per unit. We can say 5 hours per unit. So that will give me 4,500 hours. Okay, and now I will take actual hours, which is 4,200 hours. When you reduce it, you get 300 hours and it is adverse. Why? Because we are not working till the full capacity. So it is an adverse situation that we have. right? And now I will multiply it with standard fixed cost per hour. Can we calculate? Now the standard fixed cost is $50 per unit. Now let's divide it. So hours per unit is 5. Got it? So can we get the cost per hour? Yes. So we can divide $50 per unit divided by 5 hours per unit. So that will be equal to $10 per. So I will multiply here with $10. So my answer will be 3000 adverse variance. Got it? Because this shows that you have not used your capacity levels, your full labor hours level. So hence this much is the adverse situation on the entity, because fixed overheads are always absorbed till the fullest capacity. Okay, so that means if the entity does for 300 more hours, effectively it will cost the same. So the entity should do it, okay, instead of having the idle hours. Now let's go to the last one, which is 6B, which is exactly in line with your variable overhead efficiency and labor overhead efficiency variance. So I will take 6B, which is fixed overhead efficiency variance. Let's look at the fixed overhead efficiency variances. Now, when we have the fixed overhead efficiency variance, let's calculate. How do we calculate this? Simple, you will take what is the standard labor hours to make actual units. I will take it from the labor hours calculations. Then I will compare it with actual hours. The only difference is this variance I will multiply with standard fixed cost per hour and not labor cost per hour. Clear? And you get your variance. Simple. So now as per the labor that we had calculated, it was 4,000 and 4,200 hours. The same information I am using. 4,000 hours and 4,200 hours. So I get a variance of 200 hours. Now the standard labor fixed cost per hour is 10 per hour. We just calculated above. So my variance will be 2000 adverse variance. Clear? 2000 adverse variance. Clear? Done? Clear everybody? We have completed all the basic variances, but still I will just complete one small portion, that is for how would you do a reconciliation between the budgeted profits and the actual profits. That would also give you an idea whether your answer is correct or not. Here we don't have all the variances covered, so I'll take one more example for the same. But before that, one more very important exam pointer I would like to highlight here for marginal costing. Please note a very important point. See, marginal costing never says that you have to work till the fullest capacity and all, because there is no absorption of full cost to the product. We just absorb variable cost to the product, and fixed cost is a period cost there. Correct? So now when we are in the marginal costing environment, fixed overhead volume variance will not be calculated. Why? Because fixed overhead volume variance talks about working to the fullest capacity, and it is only calculated, if you observe, fixed overhead volume variance is only calculated when the standard cost is a full production cost. Okay, when the standard cost is a full production cost which is absorbed into the product cost. And in marginal costing, we don't absorb full production cost to the product cost, and we only absorb variable cost. Hence, we will not calculate fixed overhead volume variance in marginal costing, and only fixed overhead expenditure variance will be calculated. Clear? Number 2 point. this is a point to remember that when we calculate sales volume variance in a marginal costing environment, you know that we will multiply the difference in quantities with standard contribution per unit. Okay, so these 2 pointers, please remember for your marginal costing and in variances, then you will never have any problems. Let's quickly take up a question where I will take up that in an operating, basically when we are doing a reconciliation between budgeted profits and actual profits, how we can do it. So I will just take a hypothetical situation here and let's do a question here for the same. One last question for this. So quickly, let's take the question. I am taking some variances and I will show you how do we do the reconciliation. Okay, so now let's have some calculation, some variances here. So let's take an example. Here I have taken my material price variance. My material price variance is 600 adverse. Okay, I'm just putting up some figures so that the reconciliation becomes very, very clear to all of you. Number 2, I'm taking material usage variance. And that is calculated as 500 favorable. Okay, it's very important to denote as adverse or favorable when you're preparing your operating statements. Very, very essential. Okay, the next one. I'm taking is labor rate variance. So basically I'm taking a full-fledged summary, okay? Labor rate variance, and that I'm taking as 200 favorable. Then I'm taking labor efficiency variance. I'm using shortcuts to write, okay? And that I'm taking as 510 favorable. Then I'm taking fixed overhead expenditure variance. And that I'm taking as 4560 adverse variance. And then I'm taking as fixed overhead volume variance. And that I'm taking as 1850 favorable variance. Okay, now let's say if I take fixed overhead volume capacity variance, fixed overhead volume efficiency variance, I don't need to write them because volume variance is a total of the two. So don't write all 4 because we know all 4. Okay, now most importantly sales variances. So sales price variance, if I'm taking, then I'm taking this as 1400 adverse variance. One more point, sales volume variance. And sales volume variance that I'm taking as 1500 adverse variance. Both are adverse. And this volume variance I'm calculating in absorption costing environment. Okay, just to update. Okay, now let's prepare the operating statement summary. So you have got all the details. Let's create the statement. So I will write here reconciliation of budgeted profit to actual profit. Okay, now let's say, let me give you one more example, one more point. Let's say that the question gives me that the budgeted profit is, let's say the question gives me 30,600. Okay, and the actual profit the question gives me and the actual profit that the question gives me is okay. So now actual profit is also given to you because we need that for reconciliation. Actual profit is given to you is $24,100. Now let's do the reconciliation. Always remember our starting point will be the budgeted profit. So let's start with the budgeted profit only. Okay, so I'm starting with budgeted profit. The question details are given to me. Let's use that. So budgeted profit is $30,600. With this, okay, budgeted profit is this. Now it's very simple. First, you will always adjust the sales variances. Favorable variances you will add, adverse variances you will reduce. Simple. So first always, and which variance to start with in sales also, you can take sales price, sales usage, anything to start with, not a challenge, but both sales variances will be adjusted first. So now let's see here, sales price variance is also adverse and volume variance is also adverse. So I will reduce both, right? So I will do less sales price variance and less sales volume variance. Adverse, so it is adverse, price variance adverse is 1400, volume is 1500. Okay, so we will adjust here 1400 and I will adjust here 1500. Here you can write adverse just for your understanding that yes, you know it is an adverse variance. Okay, now when you adjust it, what is the profit that you get? It is 30,600 less 2,900. I will use my calculator. 30,600 less 2,900 gives me 27,700. Okay. Now, what do we call this? We call it as standard profits for actual sales. Because now you have removed the volume effects, right? So it is your actual sales which is remaining. You have reduced, you have adjusted the volume effect here. So we don't have budgeted sales, we have actual sales. Done. Now you adjust all the cost variances in the same fashion. Favorable variances add, adverse variances reduce. Just simply that way. So I will take one by one variance. So I will take here first I will take material price, material usage, labor rate, labor efficiency. I'll write down here. Right. So here I will take material price variance, material usage variance, labor rate variance, labor efficiency variance, then fixed overhead, right? Fixed overhead expenditure variance and then fixed overhead volume variance. Listed down everything, not just put it here. Price variance is adverse, reduce price variance. You can write here adverse. Material usage variance is favorable 500 and labor rate variance is favorable 200. So 500 and 200. Then labor efficiency variance is also favorable 510. Expenditure fixed overhead is adverse 4560. So here 510 we will add and 4560 I will reduce. Volume variance is 1850 favorable. Done. I've listed down all. Now what you have to do is just add the favorable and less the adverse. That's all. So when we do it on the calculators, let's take the net effect. So what I will do with 27,700, I will reduce 600. I will add 500. I will add 200. I will add 510. I will less 4560 and I will add 1850. I get here this. Oh, just a minute. I'll have to get the totals and then reduce it. Or simply then what we will do is, actually we take the totals and then we reduce it. So let's do one thing, then let's do it opposite if we are doing it in one shot only. So adverse variance you will add. Actually I follow this way, which I will be telling you. Wait. Get the totals here. Okay, get the total here and that total you will reduce to get the final answer. Okay, so let's get the totals of this only. That is negative 600 plus 500 plus 200 plus 510 less 4560 and less add 1850. So the net effect that I get here is 2100. Oh, I've taken all the variances. Just a minute. Oh, I'm sorry. I missed out few variances. The variable overhead is there. Okay, so I will just list down that variable overhead also. I will just list down them. Right. 600 is the material price variance. 500 is the favorable, 200 is the favorable, and labor efficiency. Actually, this is variable overhead efficiency variance. So labor efficiency is not 510. I'll just do the corrections in the example. So the variable overhead variance is labor efficiency variance is 3400. 3400 favorable. Okay, then 4560 is adverse here and 1850 is favorable here. Okay, and variable overhead variances I'll have to put it. So I will write it. Variable overhead efficiency variance was 510. Efficiency variance was 510 favorable. Now I need to add just variable overhead expenditure variance that I can add here. Variable overhead expenditure variance is $200. Okay, variable overhead expenditure variance is 200 adverse. That's all. Now the data is complete. Okay, so let's make the changes here. So here again, I'll have to add variable overhead variances. Variable overhead expenditure variance and variable overhead efficiency variance. Efficiency is 510 favorable and it is 200 adverse. And here we have 3400, right? It is 3400. Now let's get the adjustments. So it is, I'll just do the adjustments again. In fact, even with this now we can get it in one shot. 27,700 less 600 add 500 add 200 add 3,400 less 4,560 add 1850, and then we have less 200, and then we had add 510. Okay, now so what we get here is, I'll just get the totals here. Oh, my calculator went off. No issues. Let's get the summary here. Okay, so I will have it here. Let me do it in 2 steps only. That's better. Less 600 plus 500 plus 200 plus 3400. Okay, plus 3400, and then less less 4560, and add 1850, less 200, and add 510. Okay, now don't stop here because the story doesn't end here. Okay, the story doesn't end here. Do we need to add something? Do we need to increase something also? So I will add one more variance here. Okay, I'm doing it in steps so that the concepts become clearer. Now the other variance that we have not discussed though, but that I will just add and I will explain to you here, which is labor. That is also very much asked. Idle time variance. That is simply, labor idle time variance is simply calculated to discuss that what is, for how much time the labor was idle. Let me give you an example. Okay, let me give you an example for the same. Now let's say that my total labor hours available are 4000 and the labor is actually working for only 3800 hours. So there are 200 hours that the labor is not working. So that is a labor idle time variance, and that is always adverse because we never want labor to be sitting idly, right? So therefore idle time variance is always an adverse variance, which will be the number of hours that the labor is sitting idle for. In a simple way, it is the number of hours that the labor is sitting idle for, and that will be your idle time variance. I hope I'm clear. So labor idle time variance is always an adverse variance, which is given here in your example as 1000. Okay, now let's do the adjustments. Now we are done with everything. So now let's do the adjustments here. When you observe here, you have adverse variances, which is material variance is adverse. Then your fixed overhead is adverse. Then your fixed overhead volume variance was adverse. Fixed overhead volume variance is adverse. Okay, then your labor efficiency variance is positive. Your labor rate variance is positive. Usage variance is positive. And then you have your labor idle time variance. I will mention it separately because then you will know. So idle time variance is nothing but what is the time available and what is the time actually worked for. So that is 1000 adverse. Right, so that is also adverse here. Your variable overhead expenditure variance is adverse here, and these all are favorable. Now please just do it in 2 steps and get the totals here. So you will get the totals here and then you will adjust it with the budgeted profits. So let's get the totals here. It's less 600, add 500, add 200, add 3400, less 4560, less 1850, less 1000, and less 200, and add 510. So I get a total adjustment of 3600. Okay, now what you will do, you will reduce 3600 from here. Why? Because your adverse is more. So you will reduce 3600 from here because your adverse is more. So when you reduce 3600 from 27700, you get here 24100. Ideally, this should be your actual profits, what we have to see is whether it is meeting with our actual profits or not. Actual profits are given you 24,100. So here my question meets, and so my statements are reconciled. That means my variances are calculated correctly, and we have been able to understand that why your budgeted profits and actual profits are different. What is the reason for the same? The same has been explained in these variances reconciliation. It is important from your exam point of view, especially if you're giving your MA exams. For PM, we expect these basic understandings to be there, because many times with the advanced variances, a small part for a basic variances is also calculated. Apart from this, when you answer those MTQs and the MCQ theory questions for a section A and B, you can get a question, that can give you situation for operating statements as well. And so you would be able to get hold of it. Okay, we stop here. And guys, if you have any questions, any queries that I have not taken, that you want me to take, put it in the comment section in the chat box. I will take it for sure. If you want a copy of these notes, again, put it in the comment section. I'll ensure that these reach out to you. Please don't forget to like, subscribe the channel to follow more such videos and more such topics on which I'll be preparing the videos coming on live, and so that we have clarity on it. Just to update people, we have another live today evening. Don't miss out on that. That's for the advanced variances. So see you all today evening for the advanced variances session. Bye-bye.